So we want to talk a little bit more about the markets and what the reaction might be with Cameron Dawson. She is Chief Investment Officer of NewEdge Wealth. And Cameron, you think that the Fed's not going to raise rates basically no matter what we get with the CPI or PPI?
Well, certainly if we had a big upside surprise to the CPI, that could push the probability of a rate increase next week from the Fed. Right now, there's a very, very low probability that's priced into the bond market. It is expected by consensus forecast for CPI that you will see an uplift in the headline number coming from higher energy prices. And it's quite a bit of an acceleration, up to 0.6% on a month-over-month basis. That's likely enough for the Fed to hold for another month. But really, then it's a question of what happens to the 2024 forecast, because we do get an update to the dot plot at this September meeting. And the Fed has 100 basis points of cuts already baked into the 2024 forecast. If we continue to see CPI remain elevated above their target and growth remain robust, it really does raise the question if that forecast is far too aggressive.
Yeah, that's what a lot of people may start wondering. The Fed, if you talk to Fed officials, most of them keep saying higher rates for longer. The market may be ignoring the for longer part of that because the idea of rate cuts anytime soon, that may be a fantasy.
And then it's a question, of course, of if that matters for the equity market, because what we've seen this year is effectively that same thing play out, meaning that we have had higher rates for longer. If you went back to the forecast for the Fed path at the beginning of 2023, we would have already been in an easing cycle right now, meaning that there were cuts priced in to start in July. Of course, that hasn't materialized, but at the same time, you've seen a big uplift to equity markets driven by valuation expansion. So if we don't get the easier, kinder Fed in 24, will that matter for equities? And I think that's probably the biggest question facing the equity market going over the next few months.
What do you think the answer is? What would you tell people to do right now?
I think that as long as earnings hold up, that there can be a floor under the equity market. I think it's one of the reasons why we have seen resilient trading. We saw that short, shallow correction back in August, but we are starting to see earnings estimates get revised higher in the past couple of months. Now, of course, it's then the question of how much uplift can you get from a valuation side of things, meaning valuations for the S&P 500 back in July reached 20 times forward, for the NASDAQ 31 times forward. That seems to be a ceiling of how much we can press valuation. So in a better growth but tighter Fed environment, it likely points to lower returns. Doesn't necessarily mean big down markets, but not huge upside because of that valuation ceiling.
Hey, Cameron, real quickly, ask you about what you expect with the dollar. The dollar has had this great run. I think the longest weekly winning streak we've seen since all the way back to 2015. But there were a lot of comments over the weekend out of Japan. Just the idea that they might actually end negative rates by the end of this year. And that can turn things around a little bit. You do see the dollar index a little weaker this morning.
It certainly could. I think in the very short term, from a technical perspective, the dollar did get overbought last week. It did have that extraordinary run, as you said. And so on measures like the RSI, it got overbought. That suggests that it's going to have a little bit of a period of consolidation. But of course, if you were to see a big policy shift by the Bank of Japan, meaning the end of yield curve control, which is still something they're not contemplating until the end of this year, beginning of next year, that could most certainly put downward pressure on the dollar. So it really is remaining to be seen if we're going to see the Bank of Japan shift that policy. But if it does, it could mean a weaker dollar.